In this video I'm going to show you a high-impact liquidity method that can pull in $500 in daily gains. The best part is you won't need a big account balance to start, and this is the same technique used by seasoned pros, but I'm simplifying it so much that even complete newbies can get it. So if you're ready to discover the real tactics pros rely on, this is your chance. See you after the intro and disclaimer. Now let's get started. The entire method centers around a core principle called liquidity. But what does liquidity actually mean in basic terms? It refers to zones where buy and sell orders are waiting in the market. Let's make this clear with a real-world example. Picture this: you're analyzing a chart and choose to enter a buy trade at a specific price point. What you're doing is adding liquidity to the market. At that level, you're basically signaling to the market, I'm ready to buy at this particular price. The same logic holds true when you place a sell trade. You're saying, I'm ready to sell at this price level. And that action also contributes to liquidity. In general, liquidity exists across nearly all price levels because countless traders are placing orders all the time. This includes individual retail traders, major banks, and institutional players. So at any given price, someone is always ready to buy and someone else is always ready to sell. This is the foundation of liquidity, and it's what drives the market every single day. But it's also true that some price levels attract significantly more liquidity than others. Take this as an example. Imagine a support zone on the chart where price has bounced twice already. Now as price nears that same level again, what do you think most traders will do when they spot this pattern? They'll anticipate another bounce and enter a buy trade right at support, placing their stop loss just underneath. If they're playing it safe, they might drop the stop a bit lower to avoid early exits. You've probably seen this play out before. Instead of bouncing, price dips just under support, triggering those stop losses before reversing and shooting up again, and you're left wondering why it didn't work. This happens because large-scale traders with serious capital aim for the liquidity sitting below support. They understand that many retail traders are watching that same pattern and stacking stop losses in the same price region that bunches up liquidity in that zone. So when stops are hit, the pros use that liquidity to execute their own buy orders efficiently. This is why you'll often notice price piercing through a strong level, then snapping back in the opposite direction. Now I'm going to show you how to join the top 1% of traders who capitalize on this setup instead of being among the 99% who get taken out by stop losses. And just so you're aware, this technique is most effective on the lower time frames like the 5-minute or 15-minute chart, and it's suitable for any instrument, whether it's forex, crypto, or equities. Let's jump in. To keep it simple, I'm going to divide the method into 4 clear steps that are easy to follow. Just remember, each of these steps builds on the previous one, so skipping one means you can't move forward. Now let's start with step 1, which is spotting what's known as a break of structure in price. But before we do that, we need to quickly understand how market trends are formed. Basically, there are two main trends you'll see in the markets: upward trends and downward trends. Let's use an uptrend as an example. During an upward trend, the market doesn't climb in a straight line. Instead, it advances in a systematic pattern, creating what we call higher highs and higher lows. On the other hand, in a downtrend, the market structure typically shows lower highs and lower lows. Now in the case of an uptrend, when price pushes above the last high and sets a new higher high, that's referred to as a break of structure. Likewise, in a downtrend, when the price dips below the previous low and makes a new lower low, that's also considered a break of structure. So now that you understand what a break of structure actually looks like, now let's examine a real chart example. On this chart, it's clear that price is creating higher highs and higher lows, which signals an ongoing uptrend. To spot the break of structure, we just need to observe the point where price pushes above the prior highs and establishes new higher highs, which happens right here, and this marks our break of structure. It's crucial to wait for a full candle close above the previous high for it to qualify as a valid break of structure. Simply piercing it with a wick isn't enough. Once we confirm the break of structure, we can proceed to step 2, which involves spotting either a supply or demand zone. These zones represent areas where significant buying or selling activity entered the market, resulting in a strong price movement. The simplest method to locate these zones is to first identify a break of structure, then trace back to the origin point just before the aggressive price move that caused that break. The zone just before the strong upward move is referred to as a demand zone. Likewise, in a downward trend, the zone just before the steep decline that triggered the break of structure is known as a supply zone. Returning to our original example, since we've already identified a break of structure, finding the demand zone becomes easier. We look at the area right before the sharp move that led to that break of structure. In this case, price began its sharp move upwards at this point. To mark the demand zone, highlight the last candle right before that sharp move. Use the rectangle tool to draw a zone from the candle's low to its high. This marked area becomes our demand zone. Now that we've identified a demand zone, we move on to step 3, which is finding a liquidity level, and this is the most important step in the entire strategy. To put it simply, liquidity levels are areas where a lot of stop-loss orders are placed. Examples of liquidity levels are double bottoms, triple bottoms, or even multiple rejections from the same level. The point is, when a level looks too obvious for a bounce, a lot of traders enter long positions there and usually place their stop-losses just below it. This causes a build-up of liquidity under that level, which becomes a target for stop hunts. So what we're trying to find is any type of liquidity level that's located above our demand zone. What usually happens is that price will break below that level, sweeps the liquidity below it, and then bounces off our demand zone. This bounce becomes our long opportunity. The same logic applies in a bearish structure. What we're looking for is a liquidity level that's located below our supply zone. What usually happens is that price will break above that level, sweeps the liquidity above it, and then rejects off the supply zone, and that rejection becomes our short opportunity. Returning to our earlier example, now that we've outlined our demand zone, the next move is to locate a nearby liquidity level positioned above it. Here we notice price forming a double bottom, bouncing off the same level 2 times, which results in a buildup of liquidity beneath that level. After pinpointing the liquidity zone, we proceed to the last step, which is executing the trade. Executing a trade using this method is straightforward. You place a limit buy order right at the demand zone, add a stop loss just beneath that area, and set your take profit at a level that's twice the size of your stop loss. Or if you're aiming for a more aggressive setup, you can use the previous highs as your target. A limit order means you're not entering the market at the live price, but instead at a predefined level along with your stop and profit parameters. This approach saves you from having to watch the charts all day. Just set your limit order and let price do the rest. In our example, price dips below the liquidity point, tags the entry, and then reverses upward, hitting the take profit. Now, while this strategy may seem complicated at first due to the conditions that need to align, it's really just a matter of learning a few core principles. A liquidity level near a supply or demand zone, it's just like identifying any standard chart formation. Take a triangle pattern for instance. You're not searching for that precise price movement since charts don't behave in that perfect way. Instead, you're looking at the criteria that define the pattern, which are the converging trend lines. The same idea applies to our liquidity strategy. Don't try to match the pattern exactly on a chart. Instead, pay attention to the core components that define it. A liquidity zone forming close to a supply or demand area. That's why grasping the underlying rules matters more than just memorizing the sequence of price action. Now let's walk through another example, starting again with step 1, which is identifying a break of structure. Analyzing this chart overall, we can see that price is forming a series of lower highs and lower lows, signaling a clear downtrend, and right here we notice a break of structure as price moves below this low and creates a fresh lower low. We also find another break of structure at this point as price breaks the earlier low. Once we've marked the break of structure, we now proceed to step 2, which involves identifying either a supply or demand zone. Since we're in a downtrend, our focus will be on spotting a supply zone. To find it, we look at the latest break of structure and trace it back to the origin point just before the sharp decline that caused that break of structure. In this example, it's located right here, so we highlight that area as our supply zone. Next, we advance to step 3, which is identifying a liquidity level beneath the marked supply zone. In this case, we can observe several wicks rejecting the same price area, indicating a buildup of liquidity. This sets it up as a prime target for a liquidity grab. So now we have a confirmed supply zone with a liquidity pocket sitting directly under it, forming a complete and valid liquidity setup. Now we proceed to step 4, the final stage, which is executing the trade. Since we're in a downtrend, our aim is to short the market, meaning we profit when price declines. To enter, place a limit sell order at the base of the supply zone, put your stop loss slightly above the zone, and set your take profit near the recent lows. Then just let the trade play out. In this scenario, price taps the liquidity level, triggers our entry at the supply zone, and then moves down toward our target. This method is among the most effective strategies out there, and it's the exact approach that allowed me to make $500 a day simply by spotting this setup daily on shorter time frames like the 5 or 15-minute chart. And the best part, it's compatible with all assets, whether forex, crypto, or stocks. Now, what I just walked you through is only the foundation of the strategy. There's also an advanced version that takes things further, especially if you're aiming for consistent $500 daily profits. So let's get into the advanced version of this strategy. Just like before, we begin by identifying a break of structure. This helps us mark our supply or demand zone by spotting the sharp move that caused the break. Now here's where it gets different. In the advanced setup, the liquidity level isn't just a clean double or triple bottom. Instead, it's formed by a second demand zone created from another break of structure. The key here is that this second demand zone is a minor zone and it needs to sit just above a major demand zone. The difference between major and minor comes down to the strength of the move that caused the break. If the break came from a big strong price swing, it's a major zone. If it came from a small short-term push, it's a minor zone. Now, for this strategy to work best, we want to see a minor demand zone just above a major one. That minor zone acts as our liquidity trap, and once price sweeps through it and reacts off the major demand below, that's our cue to enter a long trade. Alright, let's break down a real chart example. Here we can see price forming higher highs and higher lows, which tells us we're in a clear uptrend now. Right here we get a break of structure. So we mark our demand zone at the origin of the move that caused the break. That's our minor zone. Then if we look a little higher up, we spot another break of structure. From a smaller price move, we mark a major demand zone just below that break. But since it came from a short-term move, we classify it as a minor zone. So now we've got our perfect setup. A minor demand zone stacked on top of a major demand zone. This creates our liquidity trap for the trade entry. We set a limit long order right at the top of the major demand zone, stop loss just below it, and a take profit at the previous highs. Now watch how price reacts. It taps the minor demand zone a couple times, showing some rejection, then finally breaks through it, sweeps the liquidity, and lands perfectly on our major demand zone, triggering our entry. From there, price bounces clean and heads straight to our take profit level. This is a textbook example of a clean and profitable liquidity-based setup. Let's walk through another clean example. On this chart, we can clearly see price forming lower highs and lower lows, confirming a strong downtrend structure. Now, while there are several break of structure points we could choose from, we'll focus on the most recent one. Right here we take the sharp move that led to that break and mark it as our major supply zone. Now if we zoom in a bit, we notice another break of structure, but this time from a much smaller price swing that allows us to draw a minor supply zone just below the major one. Since it came from a short-term move, we label it as minor. In contrast, the zone above, created from a larger swing, is our major supply zone. Now that we've got a minor zone just under a major zone, this gives us our ideal liquidity setup for the entry. We place a limit sell order right at the bottom of the major supply zone, stop loss goes just above that zone, and take profit is set at the previous lows. As the trade plays out, price reacts to the minor supply zone, rejecting off it a few times, which tells us liquidity is building. It then breaks through the minor zone, sweeping liquidity before hitting our major supply zone and triggering the short. From there, price drops cleanly into our take profit target. Another textbook trade using the liquidity strategy that's helped me consistently make $500 a day, even on lower time frames like the 5 or 15-minute chart. And the best part, this setup works on forex, crypto, stocks, literally any market. Now it's time to wrap up. Thanks for watching. I hope you found this video informative and valuable for your trading journey. If you did, make sure to smash that like button. And if you're new here, hit subscribe and turn on the notification bell so you never miss our latest video updates. We genuinely appreciate your feedback. Drop a comment below and let us know your thoughts. Your suggestions help shape this channel and keep it evolving. Speech balloon fire. Thanks again for the support. I'll catch you in the next episode. Until then, trade smart, stay disciplined, and always trust the process.